Can these companies that report get us back into a risk-on feeling, or the Fed and the bond market are going to keep us from getting too excited? What do you think?
I think that the Fed and the bond market are really important here because that's going to be the driver of valuations. As the Fed continues to tighten policy, we expect valuations to continue to come down. It's interesting that starting this year, EPS estimates have actually been moving higher. They've gone from 8% to 10.5%, all with this market volatility, which is because valuations are coming down. But if we look at EPS estimates and kind of break them down and look under the surface, we can see it's all being driven by energy estimates moving higher. Those now are expected to grow 95% this year because of higher oil prices. And if you look at the rest of the S&P, we're actually seeing things get fairly back-end loaded. So analysts are cutting their estimates for this quarter and putting them into the later quarters in hopes that they're going to make up for the shortfalls that we're seeing in the near term. So I think it's all about the forward outlook that we see from these companies and less about a one quarter, which is probably going to be pretty strong, than with the added challenge of having the multiple compression.
I mean, within the overall universe, would you, there's another big piece. I would like to be an editor someday. Someone assigned to Karen Langley at the Journal, inflation-proof stock. Do you know Karen Langley or no? No? Anyway, inflation-proof stocks are in demand. Would you buy things with travel stocks, the airlines, hotels? Do you need to have part of your portfolio in companies that will benefit or at least are resistant to inflation, Cameron?
So we're certainly seeing those reopening stocks. I don't know if I'd necessarily put those directly just in the inflation benefiting camp. Reopening stocks are doing better because we are seeing a shift from goods to services. Look at the spread of performance between things like specialty retail, which is down 20% year to date, and airlines, which are up 5% year to date. So clearly there is this shift in consumer demand from goods to services. Now, the inflation benefiting areas like energy and materials, those are certainly holding up, and those are the areas where we are seeing the most EPS revisions higher. So we see strong relative trends. And in this market, you really want to be buying names that are in strong trends on a both absolute and relative basis, instead of trying to catch a falling knife in areas that have really broken down. So those inflation benefiting areas, we think that we would still be wanting to be overweight.
Okay, Sylvia, there's a lot to digest in all that. Start with what you think the reporting season is going to look like, Sylvia. Who's going to do well? Who's going to forecast better times ahead? Who's not going to do so well?
Yeah, I think, if we just sort of take a step back and think about the macro environment, we had coronavirus, we had the war on Russia, we have inflation, we had Fed hikes and things like that. And that's just put a lot of pressure on the market. So earnings is really on deck here. And I think that, retail investors are very much looking for positive news out of earnings. If we don't get that, I think it will be a risk to kind of this volatility and staying on some of these market lows. But, to Cameron's point, I think that there are a couple of good things going on. A lot of the companies have actually continue to report solid earnings. They have strong cash balance sheets. Consumer spending has remained strong. So some of those consumer discretionary types of names may look good. You have names like Tesla and I think some of the large cap, mega cap companies that were just absolutely beat up. I think if they deliver on earnings and show some strength there, the consumer might be interested there. And I actually love the travel stocks. The open trade, I think, is just going to be absolutely on fire. So the hotels, the cruises, and the airlines, this is the travel reopen trade that just hasn't happened yet because Omicron and then the next variant kept coming into the system, increases in geopolitical risk and oil prices and things like that. But there's so much pent up demand. January and February domestic flying was up 38%. Global business travel is poised to be at $1 trillion now, which is sort of, back up from the lows of the last 2 years and looking like 2019 levels. So I just think a lot of money is going to go there. As Cameron said, you're going from goods to services. There's $2 trillion in savings. Consumer has 7% wage increases. So those, I think, are the names that are going to be interesting during earnings season and are good trades to look at.